Hello and welcome class 11 commerce students. Today in this class I am going to explain to you one important topic from insurance chapter. Insurance chapter is included in your first unit test exam, and the most important question from this chapter is principles of insurance. What are the different principles, or describe the different principles of insurance? This is the most important question. It often comes and it contains generally 6 marks. So it is the lengthiest question that you might get in first unit test and as well as in your annual exam. Very important question from the whole of business studies syllabus as well as from the insurance chapter. So today this is a lengthy answer. So I will try to complete a part of these in this video, and the other part of the answer I will the rest part of the answer I will try to complete in the other video. This answer being a large one, I won't be able to complete the whole answer. I'm telling you, I won't be able to explain the whole of this answer. Maybe I may not be able to complete it in one video, so I will continue the rest part through some other video. So I'm just starting the principles of insurance. It contains many points. It contains almost 7 points in this answer. 7 points you need to explain one by one. What are the different principles that insurance should follow? There are 7 points. So first I will explain in this video about the 4 important points. These 4 points I will try to explain in this video, and the remaining 3 points I will complete in my next video. So let me start by one. The first, you can see the first point is utmost good faith. Among the various principles of insurance, the first point is utmost good faith. As you can see, I have written utmost, that is principle of utmost good faith. Principle of utmost good faith. According to this principle, insurance is a contract based on faith. The insured and the insurer must disclose all the material facts to each other. They should not hide any matter with anybody. They must believe in the theory of full disclosure. Each one of them, whether it is insured or the insurer, both the parties, the two parties that are involved in this business, must disclose every fact and figure to each other. Now, insurer is required to disclose all the terms and conditions of the contract, and insured is required to complete the details of the material facts related to the risk being proposed. If the insured hides any material fact from the insurance company, then later on the insurer comes to know about it, then he can refuse for the compensation. So the insured must be aware of the fact that he has to fully disclose about all the material fact of the risk that he is proposed to do, all the risk that he is intend to be covered up, all the risk that he needs to be compensated, all the material facts he need to disclose. So insured must keep in mind this thing, and insurer must keep in mind that he must accurately mention all the material fact and all the terms and conditions related to this insurance policy. So this is a relationship of utmost good faith. So the first principle to be followed is utmost good faith, as you can see. Now the second point is insurable interest. As you can see, I have written in the board. According to this principle, the insured must have an insurable interest in the subject matter of insurance policy. Without insurable interest, an insurance policy can be called as a gamble and a fraudulent activity, and the law does not permit for it. So there must be an insurable interest. For example, in case of a life insurance, the insurable interest comes with the relation of insured with the person for whom the policy is taken. That is, person can take life insurance policy for the person, for his spouse or for his children, but he can't take the insurance policy for a stranger. In case fire insurance, the insured must suffer a financial loss if the subject matter is damaged. That is, he must be the owner of the subject matter. He must be the owner of the property for which loss has been caused. or he must have taken the insurance policy of life insurance policy of somebody with whom he is directly related to. So this is the matter of insurable interest, without which law will not permit the insurance. Now the next point is principle of indemnity. According to this principle, the purpose of insurance is to bring back the insured in the same financial position. It means that due to the loss, due to the sudden occurrence of loss, the insured has faced a huge damage. Now, according to this principle, the purpose of every insurance is to compensate the financial position, is to indemnify the loss, to compensate the loss suffered due to the damage. So this is the principle of indemnity. It is the duty of insurance company to bring back all the sufferer to the almost same financial position as he was before the loss or the damage occurred. Maybe it is not fully possible to recover the loss, but as to the maximum, the insurance company may try to just cover up the loss to the maximum, to the fullest extent, so that the financial position tries to be remain in the almost in the same condition as it was before the loss. For example, a person insured his factory for 2 lakh against the fire. Due to fire, he has suffered a loss of rupees 1 lakh. The insurance company will try to compensate him for 1 lakh only and not the policy amount of rupees 2 lakh. If he has suffered the loss of rupees 1 lakh, then the insurance company must try to compensate the sufferer the damage of rupees 1 lakh. So the damage amount, the particular damage amount should be compensated and not the full policy amount. Indemnification should be of that amount for which loss has been caused. So loss is tried to be recovered through this policy of indemnification. Now last comes last for today, principle of contribution. The principle of contribution is corollary to the principle of, principle of contribution is related to principle of indemnity. These two are correlated, these are corollary. According to this principle, if a person has taken more than one insurance policy for a subject matter, then different insurers will contribute to the total amount of the loss, to the amount assured by each. In case one insurer pays the full compensation for the loss, he is entitled to receive a proportionate amount from the other insurers. This principle is not applicable to life insurance. That means if I have taken insurance policy with more than one company and I have suffered a loss of rupees 1 lakh, then that 1 lakh rupees will be recovered by all the insurance company proportionately. If one insurance company has paid the maximum, other will pay the rest of the amount. That means the total amount will be covered up by all the insurance policies that I have taken proportionately. All the insurance company will try to cover up for the loss proportionately. If somebody does the maximum, the rest part others will do. It is not like every company will be paying for my 1 lakh rupees. Each and every company will not pay the whole amount for one loss. If I have suffered a loss of rupees 1 lakh, then all the companies will not pay me 1 lakh each. I cannot be in a profitable position through this loss. This is the point. So I have to be covered up for this rupees 1 lakh only, and that is to be covered up by the insurance companies. If I have done the policy with one company will try to compensate for that 1 lakh rupees that I have suffered. If I have carried out the insurance policy with many companies, then all of them will sum up for the whole 1 lakh rupees and they will try to recover the 1 lakh rupees. Proportionately they will give their contribution. That is it. I cannot make profit out of the situation. That is what this principle states. So in this way, these are the 4 important principles of insurance. There are more importance of principles of insurance which I am going to explain to you through my next video. So wait till my next video. Goodbye.